Yo, what's going on, boys? Welcome back to another video. Today we got another banger for you guys, but today it is a little bit different. Today I'm going to be going over the discount and premium sections of the range. Now, if you're asking why I'm making this, I apologize. There's an airplane flying over my house. Damn. I apologize. But if you're wondering why I'm making this video, it is because someone I posted like an Instagram story and I was like, what do you guys want me to make a video on? And then I got a couple of like discount, premium range, stuff like that. So I'm gonna go over it, what it actually means, and how you can use it to your advantage as another confluence to know when to buy, when to sell, when to take a trade, stuff like that. All right. So the best tool for this is gonna be your Fibonacci. My Fibonacci levels are as follows. I feel like I show them a lot, but again, 0, 0.5, 0.1618, 0.705, 0.786, and then 1. So your OTE range is basically, all these numbers are basically ranges, and the best way that I've heard it being explained is like what TJR said in the TJR bootcamp, and I remember this from like 2 years ago and I used to watch it, and he would say, let's just say this is your range, right? And then your range, so this is your range, right? From the low to the high. What you would do is you would mark out, I use the GAN box personally just for the 50%, but let's just say this is your 0.5. This is your equilibrium, right? So basically what the premium and the discount are, or whenever price comes under this, price is in a discount. The reason it is in a discount is because turn that off. The reason it is in a discount is, imagine, right, you're buying, again, M and Q, like you're buying M and Q. So when you buy the M and Q, like think about buying like a bag of Doritos, right? That's what he said in the video. He's like, if you see like Doritos for $3 and then 50% off, so for $1.50, you're going to be more likely to want to buy the one that's on a less price. The reason it is discounted is because you were in the 0.5. So you're going to hear a lot of times creators are going to be like, yeah, it's in a discount, we just have the premium, but that is not the only level, right? 0.5 is a big level. However, I don't think it's considered a Fibonacci level, but basically what I'm trying to say here is these levels pretty much, they just show, like, let's just say this is high. They just show, like when mathematically these numbers are proven to come, and then price will, like, sometimes you chase off of them. So when you mark this, all of these levels here are pretty good. A lot of times you're gonna see something come in, right, tap like a level, and then react off of that and then continue higher. Same thing goes for if you were in a downtrend. It does change. The equilibrium will stay the same, but let's just say, again, like you're in a downtrend, right? And then you go up, high, low, feel the, all right, okay, like this, sure. Doesn't really matter, but obviously you guys see we're in an uptrend here, we're going up, and then we're in a downtrend here, we're going down. Basically what I'm trying to say is, right, if you mark out you would go from the high to the low, or you would see how the numbers are flipped. That is because you see how on here they're on the bottom, and then on the downtrend they're going to be on the top. The reason for that is, again, you're going to be in a discount and it kind of just flips. So like if this would be 0 because this is the lowest, and then this would be 1, it would come to 0.5 in the middle, right? Same thing here, but this would be 1 and then this would be 0, or this would be 0 and this would be 1, so opposite, and then you would come in and take the point levels, whatever. But basically all you need to know is that, I'll break it down. Now that we know what it is, all you really need to know is that, how's it called? When you mark it out in a graph, there are internal and external ranges, and I'm not going to get into too much to that, but it's pretty simple. Like it's literally just, you see the external range would be from this low to this high. The reason this is the external range is because it is the whole range which we're trading within, right? The internal range would be something like this, for example. If you see this small move right here, the internal range of this would be the low and the high, and you can see this would be your internal range. So we have multiple different ranges, and usually the external ranges are almost always a lot higher time frame. These are the internal ranges are helpful when you have small moves and you're trying to see where you're trying to bounce off of. And I'll give you guys an example. So let's just say you're taking a trade, right? And for example, like today we had like a low here and then a low here, and then we came up to all time, we swept this low, swept this low, we put in this SMT, then we inversed the gap, and then we came back down, and I believe we took the 0.5 of this internal range right here, so I can make it easier for you guys. So The external range again would have been this new low because it is the most bottom low to this high. But I was looking at the internal range, which would have been this high, and then I was looking for the 0.5 to get hit. It got hit, and then I saw my inversion upwards, and that is what confirmed my bias, right? So you can take your long entry here, and then you can just target, right, your draws on liquidity above, whatever that may be, like the high. So that is helpful. Another reason how you could use it is, again, higher time frame moves. This works a lot. Like, I don't have a actual example at the moment, but you can probably see, like, if you were to go through this low to like this high, right? Where does this come? This doesn't hit the 0.5, but you can see, like, let's just say at the time it would have been this high. You see how, for example, we make this high right here. What do? We come in, we tap the 0.618, and then we reverse off of that level. Then we could do the same thing here. Let's say we're in a downtrend. We come in, we tap. Oh, wait, I did this wrong. Let's say we're in a downtrend, right? Come in, and then do we see a reaction off of a level? We see that we tap the 0.705 between 0.786, and then we see a nice reaction that is later into a fair value gap, and off of this fair value gap, we distribute higher, right? So these are the things that you really need to be looking at when you're seeing moves happen and develop, because they're basically helpful because you're going to see, not know when exactly, but you're going to have a very good overview on when price wants to react, when price wants to bounce off of certain levels. And you're going to realize that a lot of times a random bounce really isn't random. It's just some type of, Fibonacci level or other confluence. So yeah, that was pretty much it. I feel like it's not that difficult to understand, especially when you have, like, just simplified. And that's pretty much it. So again, if you guys want to see my Fibonacci levels, these are them. You really only need 1 through 0, so like the point whatever. I use negative 2.5, negative 3, negative 2. I don't really use those. I just have them on my chart for future purposes, but that is pretty much it. Not much to it. Yeah, so make sure you guys do fill out the stories. I will say who because I believe, I just remember seeing it, like, oh, it expired, bro. Never mind, it expired, but I just remember someone was like, do a video on discounting ranges, so I got y'all. Yeah, thank you guys for watching. Make sure to like and subscribe. Definitely down to do more videos like this if you guys are interested. And then code mish on alpha. Boom. Code mish on alpha. Got y'all, boys. Thank you for watching. Have a great rest of your day, and peace out.